Hello, everyone. We are getting started now. My name is Nathan Were, and I would like to welcome you all to this webinar on digitizing bulk payments in agriculture, where we interrogate one of the key questions, whether mobile money is cheaper than cash. So wherever you're joining us from, thank you so much for making the time. So to get us started, I'll be the moderator for this webinar, and I'm going to give you some preliminary information as we get started. First of all, UNCDF and CGAP have been collaborating in Uganda on digital payments in agriculture on very specific projects. And one of the projects sought to examine the cost implications of cash and mobile money as a basis for strengthening the value proposition to support the transition from cash to mobile money. With the help of consulting firm PHB, we undertook a rigorous research exercise, and today we are going to be presenting the findings of this result. So to help me present the results of this research is a team of 3 people. I'm just going to ask them to introduce themselves, and then we will get started.
Hey, my name is Bram Peters. I'm the Country Technical Specialist Digital Finance for UNCDF in Uganda.
Cyprian Panturu, PHB Development Partner.
And Pat Kwaran, I'm an associate with PHB Development.
So for our webinar today, we basically have 1 hour for the presentation, and then we'll have about 20-25 minutes for the question and answer. So after the introductions, we will go through the value chain context and objectives of the value proposition mapping exercise, similar to what you'd call activity-based costing in the manufacturing space. We'll then look at the value proposition mapping results and the business case for the mobile network operators, because one of the key outcomes of this research was to unlock the business opportunities that exist within the agricultural value chain for us to take advantage of. And then we'll run into some conclusions, and then we'll move to your question and answer. So on your chat box, on your webinar screen, you will see on your extreme right-hand corner, chat. So if you click there, then you should be able to type your question. But remember, in the drop-down menu, where there's the word send, please select all participants. There's a couple of options there, all attendees and the others, but please select all participants so your questions are visible to everyone. The other thing I want to say also is that feel free to send in your question every time, all the time through the presentation, and we'll be able to tackle them at the end of the discussion. Please also note that this is an audio broadcast, so your microphones are on mute, and we can only hear back from you through the questions that you type through the chat box. And finally, this webinar is being recorded, and the PowerPoint presentation together with the recording will be shared at the end. So without much ado, I would like to invite Bram Peters from UNCDF to get us started.
Thank you, Nathan, for the introduction. UNCDF in Uganda is involved in a number of agricultural value chains, and the primary objective is to for financial inclusion through the use of digital financial services. And to that extent, we work in 5 agricultural value chains: coffee, seed oil, dairy, maize, and tea. Out of the 5, coffee is the most mature project that we have, and for that reason we selected coffee for this exercise that we did with together with CGAP and PHB Development. Now, if we go to the specific objectives and the approach that we took, as I explained, we work in quite a number of different agricultural value chains, and one of the things that we learned that it was quite hard to generate uptake, and to that extent we decided to dive a little bit deeper into the value proposition for the different stakeholders in the value chain. So in the value chain you have the, as we call it, an off-taker. In this case it's Chagilani Coffee, which is a big coffee exporter, one of the biggest in Uganda. Then we have the smallholder farmer. These are the typically farmers that have a small farm, say up to like 3-4 acres, and growing coffee, but also other crops. And in between Chagilani and the smallholder farmer, there are a number of traders, coffee traders. And the last but not least, the stakeholder that is important, that is MTN in this case, which was our MNO partner in the project. And we specifically focused for them on the business case to go into the rural, more remote locations.
Yeah, thank you, Bram. So pick it from there, and Paul will take us through the research overview and present the findings from the value proposition mapping exercise.
Yeah, so the main focus of this exercise was on building the value proposition mapping models. So this is mostly exploratory research we're talking about with a small random sample. So the results are not really generalizable in any sense of the word. However, the low variance in the data we collected does inspire some confidence in the results. So after talking to a handful of farmers, the results started looking pretty similar. The farmers' lives, their market behavior, there's not very much variance in terms of where they buy their products and where they sell their coffee, you know, what their income comes from, and so on. So we interviewed 22 people. We're talking about 8 small and medium farmers, and then 12 small and medium traders, and then a couple of large traders. After doing those interviews, we went into a detailed analysis of the agribusiness's payment process and cash movements. That's Chagilani Coffee we're talking about there. And after that, we went into a detailed analysis of the mobile network operators' mobile money revenues and cost structure. So value proposition mapping, what is it? So we're talking about an approach that was adapted from traditional activity-based costing methodologies. So what we did is we interviewed stakeholders. Each interview took about 3 hours, and we mapped their payment behavior over the course of a year on a month-to-month basis. So we were incorporating virtually all of the sales and purchases that these people were conducting over the course of a year, and also where these transactions took place. And so in order to estimate the cost of conducting payments in cash, we looked at the transportation costs related to each transaction, the cost of time spent on going there and doing that transaction and then going back, and then the value of risk that interviewees place on traveling with cash. That one is a pretty important one, and we'll talk about that one a little bit more a little bit later in the presentation. And so in order to, then we compared the cost of making these same payments digitally. So in a hypothetical situation in most cases, because most of the people we talked to were not receiving significant mobile money payments already. In order to do that, we're looking at the fees that are charged to do transactions. In Uganda, they're referred to as P2P payments, and in most other African countries as well. And then the fees for cashing out in most cases. This is a regular practice in Uganda. We'll get into this a little bit more later. But if you want to pay someone with mobile money, you usually have to add cash out fees to that payment. So just to give you a little idea of the people we're talking about here, this is Fred. He's sort of an example of an average farmer that we interviewed. He's 37 years old, he's married, he's got 5 children. He's located about a 30-minute drive on a boda, which is a small motorcycle taxi from the Manafwa washing station, which is where he sells his coffee to Chakalani Coffee, and it's a gravel road, and it's an uphill road as well. And that's sort of a medium distance we're talking about there. So his farm size is 5 acres. He's growing 3 acres of coffee and then 2 acres of other products. It was matoke and onions for him. His cash risk value is 20,000 against 800,000. So the way we asked about this risk value is we looked at his largest cash transfer over the course of the year. In his case, there was a transfer of 800,000, where he was selling a relatively large amount of coffee to Chakalani Coffee and got paid 800,000 for that at the washing station. So we then asked him, okay, so you're going to travel with this 800,000 back to your farm. How much would you be willing to pay for insurance to be 100% sure that you can get to your home safely without anything happening to this 800,000? And his answer was 20,000. There was some variance in farmer answers to this question, but they were still relatively similar. So Fred thinks mobile money would be a good way to get paid for his coffee, but the answers to this question do vary. When it comes to his annual income, he's making about 4.2 million shillings. We're looking at the right-hand side of the slide right now per year. That's about $1,200 per year. And his annual expenditure is about the same. About around 48% of his income is from coffee sales, and those happen between August and December. Then he gets around 23% of his income from selling milk. He's got a couple of cows at his farm, and then he is engaged in some onion trading. So he buys some onions when the prices are low between December and April, and then sells them when the prices are high in February. So his annual expenditure, he spends most of his money, around 26%, on food. His school fees for his children happen in March, June, and October, and that's around a quarter of his expenditure. Livestock in November, he happened to have sold 1 cow in November, and then we have some smaller expenditures. So value proposition mapping, this is what the map looks like. So it might be difficult for you to see this. Don't try to strain your eyes. We're going to zoom in a little bit later. And there should be a zoom button in your top right corner if you want to zoom in even further. So if you look at the left-hand side of the red line, that's the questionnaire we used, essentially. So we would meet with each of the farmers or traders and go through this column by column, square by square. When did you buy whatever you bought? Where did you buy it? How much did it cost to get there? And so on and so on. And on the right-hand side, we're looking at the analysis part of this, and that's what we're going to look at in the next few slides now. So if we look at this, again, you can zoom in if you're having trouble seeing this in your screen. So the figures are in thousands of Ugandan shillings. So if we look at the coffee sales row, the 27.77, that means 27,000 basically. And each of these squares or cells is the average of all farmer answers. and refers to how much it costs to conduct one average size transaction. And just so you know, for the people who are not in Uganda, one US dollar is 3,600 Uganda shillings, but yeah, not that important in this context. So if we just go by this column by column, the first one is percentage of total. Now we're looking at farmer receipts. So 50% on average, the farmers we interviewed, is coffee, and 2.2 is livestock or livestock products. Close to 40% is other agricultural produce, and then we have some smaller percentages there. The next column is the total cost of cash, and like we talked about before, that's the cost of risk plus the cost of time plus the cost of transport to getting to wherever it is that they make their trade. The next column is the total cost of cash, only including risk. We're going to get into that a little bit later, but in most cases, we're actually only looking at the cost of risk and not the other factors. The next one is the cost of DFS without cashing out. In this case, it's 0 because it doesn't cost anything to receive mobile money. Your expenditures come when you actually start spending mobile money. The next column is value proposition versus cash. So it's essentially comparing this 0 to the total cost of cash. And of course, that's positive in all cases here. And actually, we're comparing the total cost of cash, risk, time, and transport for this. And then there's the total cost of DFS in the next column, including the cash out fees. So then we start seeing some negatives on the right-hand side, like before. So if we get into looking at the actual results, we look at the remittances received row right now. So there we're looking at a very positive value proposition. So we're looking at 87,000, which is what it would cost a farmer to travel to wherever it is they want to give money to, and give that person the money, and including the cost of risk, the cost of time that it takes to travel there, and the cost of transport. When these people at least are sending remittances, they're sending them over very long distances. They're located in eastern Uganda, maybe they're sending them to Kampala or something, and that's why this number is very high. And if you compare this to the cost of DFS with cash out fees, that's around 1,900. So that's obviously a very, very positive value proposition. And this is where a large portion of the current mobile network operator revenue is coming from. And if we only talk about revenue from mobile money, this is a huge majority, obviously. But in other cases, we can only actually look at the cost of risk, not the cost of risk, time, and transport. Why is this? This is because if we take livestock as an example, if a farmer is going to sell a cow, he's going to have to travel to the person he's going to sell this cow to with the cow. He can't just send that person mobile money and then somehow the cow gets there. The goods usually exchange hands in the same location. So that's why we only look at the cost of risk for most transactions, actually. In the case of livestock, we're looking at a risk cost of 1,200 compared to the cost of DFS with cash out which is higher, 1,900. So that's a negative value proposition right there. So if we just look at coffee sales, which is obviously the main thing we're looking at here, that's negative value propositions in every case. They're slightly negative. They're not very negative. So that probably means that uptake is going to be relatively low just looking at this. But we're going to get into that one a little bit deeper later. So if we just look at coffee sales, the cost of risk is 3,500 compared to 3,580 roughly for the cost of DFS, so that's a slightly negative value proposition. For other agricultural produce, that's 2,900 compared to 3,600 roughly, so that's a more negative value proposition. So like I talked about earlier, the cost of DFS without cashing out is 0 because it doesn't cost anything to receive mobile money, but the costs actually start kicking in when we start looking at payments. So can people actually use this mobile money for anything, or do they just have to cash it out immediately? So actually, we have to consider the cash out fees in the transaction costs. Because the usual practice in Uganda is when you want to pay someone with mobile money, they're usually willing to accept mobile money if they're already registered for mobile money and so on and so on. But they'll usually ask you to add the cash out fee to that transaction. So like we talked about earlier, the cost of cash for most of the payments includes only risk. So it's only for things like airtime, potentially school fees, assuming the schools have been signed up, and so on and so on. Remittances, obviously, and then there's some other expenditures. For the rest of the transactions, we have to look at only the cost of risk. So in general, positive value propositions are there. Like we talked about earlier, we have school fees. We do have livestock there when it comes to paying for livestock. We do have some trade purchases, land purchases, like airtime. It's pretty small. We have school fees. That's a pretty big one. We have remittances, but and that's a pretty big but. These are high-value transactions. So they're likely to be affected by the limited level of agent liquidity in very rural areas like the one we're talking about. So in addition to that, the timing does not necessarily match that of their income. So they get most of their coffee income over the course of 3 or 4 months. But in the meantime, school fees, for example, that's a big one, 27% of their expenditure. They happen 3 times over the course of the year, so they're not directly in line with the coffee payments. So we can't just assume that farmers will be willing to accept mobile money payments for the coffee because they're going to pay for school fees, because they don't necessarily happen at the same time. So faced with the cost of cashing out, farmers are actually left with limited use cases for the digital income they receive. And that's actually mostly airtime and remittances sent, and to some extent school fees, where we're left with positive value propositions. As a result, the conclusion on my part of the presentation is that there's a need for eliminating the need for cashing out. So we have to enable farmers to use mobile money for nearly all transactions without being forced to cash out. And not only farmers, we have to also enable the people they are paying the money to be able to use that money without cashing out, because otherwise the cash out fees would just be pushed down this chain.
So thank you very much, Paul. I just want to remind you that keep your questions coming. So if you look at your webinar screen, at the extreme right-hand corner, you will see participants, chat, and PDF notes. So if you click on chat, you'll be able to see a place where you can type your question. And as you select to send, please select option all participants. There are a couple of options in the drop-down menu, including all attendees, but please select all participants so we can be able to view your questions and then answer them at the end of the webinar. Please keep your questions coming through, and we will be able to respond to them. So Cyprian Panturi is going to take us from here and continue with the presentation of the results.
Thank you very much. Well, there is a lot of content in what we've seen, and it's been unfolded by Paul up to now. Now we're going to continue looking at the off-takers, so the agribusiness, the coffee company, in this case Chagalani Coffee Limited. And we've done value proposition mapping also for them in order to see what would be in for them to make the switch from making cash payments to making digital payments. So for this, as it's been said at the beginning, we mapped the current payment process in cash. We took into account the different expenditures, different costs intervening there. And then we also modeled the process, the digital process, and how that would impact in terms of cost of payments. So in here, we are looking first at the direct cost savings that are implied by making the shift to digital payments. And we identify that digital payments are 27% less expensive than cash payments in the case of Chagalani Coffee Limited, and based on their structure. On the left-hand side, you have the direct cost per cash payment, and there you would see that almost half of it is represented by the cost of staff. So these are the different people intervening throughout the payment process. And so from counting the money, from putting it in envelopes, getting it to the actual farmers and getting it out there. The next element is the cash transport cost. It is quite intense in the case of Chagalani Coffee Limited. There are 6 washing stations uphill, as it was said by Paul earlier, and at 1 to 2 hours away from Mbale, from the main factory. So there is a lot of back and forth in terms of moving cash from the factory to the washing stations. Of course, we also took into account the cost of working capital. Basically, this is the cost of the money sitting at the washing station up to the moment of collection. The cash insurance cost, this is for the cash in transit. And then the bank fees are mainly at the factory level, not at the washing station level. What we also seen is that stationery, so printing, all the payment slips, so on and so forth, is quite important, having envelopes and all of that within this equation. Now, comparing on the right-hand side, you will have the direct cost per DFS payment. So we present this as a percentage of the total direct cost of cash. So first element that we can see in here is the fact that already the cost of staff is divided by 4 in moving to digital payments. Of course, the main cost drivers here are the MNO fees. In this case, it is a mobile money as a digital financial service. And on top of that, there is an aggregator involved. Therefore, there are aggregator fees included in the transaction cost. In terms of DFS equipment, these are basically laptops available at the washing station to conduct the transactions. So all in all, by comparing the two, we have seen that moving into DFS payments would represent a 27% economy based on the direct costs. Of course, the main drivers, cost drivers being the cost of staff in the case of cash, and the cost driver for DFS payments is, of course, the fee per transaction, which represents some 70% of the DFS cost per transaction. Okay. Moving on to the next slide. On top of the direct costs, the direct cost comparison between cash and digital payments, we also looked at indirect benefits that could be brought by moving into digital payments. So these are additional, and these would be proven by adopting digital payments in the case of Chagalani Coffee Limited. And these are evaluated as indirect benefits on top of the direct cost savings that we just seen before. So there is a 60% in the total benefit, in the total value proposition of moving to DFS payments. 60% is represented by the direct cost savings, and then 40% by additional elements that we have considered. So one of the first of them is represented by the time spent by the farmers or the workers queuing and waiting to receive their cash payments. In this case, in the case of Chagalani Coffee Limited, this is around 17%, and it is actually twofold. Is on one hand the fact that workers are paid, for instance, for the full salary, whereby some of their time is spent on waiting for the cash payment, and on the other hand is the fact that the farmers are waiting instead of bringing eventually more input to Chagalani. This applies even more in the case of traders, and what happens every now and then is that the traders will have to spend the time over, and mainly in Mbale, so at the factory, so waiting for the payment next morning. So what we took into account here is the fact that actually Chagalani is missing on input. The traders could actually use that time rather to bring more coffee instead of just waiting for the payment. We have looked also at a loyalty effect, as long as the DFS value proposition is strong enough so that more farmers and more traders would actually bring the coffee to Chagalani instead of going to the competition, because they are paid in time, they have visibility on, and they are able to plan based on the payments they are receiving. And last point, again, this is a particular case maybe for Chagalani, is the fact that there is time that is spent by the washing station managers going and bringing the cash over to the washing station every other day. The point made there was the fact that instead of doing so, doing all this back and forth for half a day every other day, they could actually spend more time and focus on the coffee received from farmers and on the grading of the produce. So all in all, this gets us to digital payments being, in the case of Chagalani Coffee Limited, again, 45% less expensive than cash payments, when taking into account all the additional opportunities that are brought by making the switch to digital payments. So, summing up on both what Paul presented so far and what I presented so far, we came up with short-term recommendations, let's say, coming out of this research exercise. What we have seen on the receipt side, and when it comes to the coffee sales, indeed there is value in pushing through and digitizing coffee sales. There is a clear value proposition in that sense for the off-taker, for the company, for the coffee company. Although the uptake is likely to be slow in the current context, mainly because of the level of acceptance for traders and then for farmers throughout the chain. Of course, one of the elements that is highlighted here is that there is no clear value proposition or strong cost difference if we are comparing the cash payments for coffee against the DFS payments for coffee. They're pretty much at the same level. Now, on the other hand, what can be done in the short run to boost the uptake is more looking into the payment side. As it has been presented, the use cases right now are around 6% on average, looking at airtime purchases and P2P transfers. whereby on the other hand, they would receive some 50%. Of course, this varies from one person to the other. This is an average. So the idea here would be actually to now push and get involved into digitizing, going for, let's say, some quick wins, relatively quick wins, and digitizing some additional purchases the farmers are doing. So, for instance, one of them could be the agricultural inputs. This is also a goal of the off-taker of Chagalani coffee, hoping that by doing digital payments and organizing the agricultural inputs, they would get better inputs, good quality inputs, and they would get a better usage than creating a better yield out of the field. So this represents on average 8% of the farmers' payments today, but is expected with the support of Chagalani Coffee Limited and getting to the optimum level of agri inputs is expected actually to grow. The other element that could be looked into on the payment side is definitely the school fees. This represents 27% of their expenditures throughout the year. Note that school fees are in Uganda are paid in 3 installments throughout the year. And as Paul was mentioning, the payments for the receipts from coffee don't necessarily match the payments for school fees. So this is, let's say, at conceptual level, the goal being to match now the DFS receipts against the DFS payments, or try to get the two in line. By doing so, it means that people would reduce the need of liquidity going back to cash, as they have use cases, clear use cases for the digital funds they receive. Now, beyond this, we would like to go now into, let's say, the thinking around the business model that can fuel, let's say, a transformative approach. So in that sense, we would just take an example, let's say, from a typical day in Uganda. This is just for as an example. So somebody wakes up in the morning, they get on a motorbike, so boda boda, which is quick transport. They get to the main road where they get into a bigger taxi, they buy some fruits, they get another moto taxi, they get to work, then they buy lunch, then they work again, and in the evening now they're getting another motorbike, have a drink with friends, then get some grocery, and then on the last motorbike getting back home. So if we're looking at this example, it's just for as an example. This represents like about 10 payments in a day. Half of them transportation, half of them are related to consumption. What is interesting to note here is that each and every time the customer is there for the transaction. The customer is on the motorbike, the customer is in the taxi, the customer is at the restaurant to buy food, the customer is at the grocery shop to buy several elements and bring home. It's basically the payer is always present at that particular location. So when we are comparing this with, let's say, the use cases, the identified use cases as of today for mobile money, we can see that the distant service payments, such as remittances, paying the bills, and even paying school fees, although, as Paul was mentioning earlier, in the particular case of farmers, note that the schools are just next door. It's basically a walking distance. These are marginal service within the value proposition for adopting digital financial services. Now, we will take as an example, in this case, we are looking at the customer fees in Uganda from MTN Mobile Money. As a reminder, so 3,600 Ugandan shillings are about $1. Now here, what is important to note, and this is true across mobile money service providers, is that the payment transactions take place on the first three bands that we see here. So up to some $4, let's say. So these are small value transactions. If we're looking at the tariffs, and as it is today in this particular case would be, let's say somebody would do a P2P to pay for their goods, we can see that in terms of these tariffs as a percentage of the average value for the bandwidth, they go from 17% and down to 10% on the third band. If we are just considering the example that we've seen a minute ago, so, and taking into account, let's say, the market behavior here, whereby if you want to pay with mobile money, you would be asked to top up with the cash out, then in this case it would be some 5,800 Ugandan shillings a day out of those 10 transactions. So considering this, considering the fact that the customer is physically present and the cash is just in his or her pocket against, let's say, the cost the transactions, the mobile money transactions incur, regular payments and really getting into the regular payments happening digitally, it is quite unlikely to take off. So this being said, based on this, what we see is that there is a clear need to provide affordable payment use cases and regular payment use cases for DFS. And this is definitely, there are several reasons for that. One of them, for instance, is getting regular payments digitally would help with the customer, being used to using the DFS service, DFS properly, and on the long run, that would also help to reduce the cash out or withdrawal need, therefore helping with the liquidity challenges that agents are facing today. So as we've seen previously in the value proposition mapping, in the case where customers can do without the cash out, then most of the elements, whether it's receipts or payments, they have a positive value proposition in DFS. It is also work to be done basically with the DFS providers out there in order to shift the mindset, let's say, and the pricing models from, let's say, value to volume driven. Of course, these transactions are low value, but the volumes in regular payments are huge. So in the case of Uganda, for instance, mobile money is primarily known for remittances. So that is definitely, as we've seen, there is a very positive value proposition there. There is no doubt about it. When somebody needs to transfer money remotely, they will be using mobile money. Nevertheless, when it comes to payments, and given the fact that they are just there, the cash is king. The last point would be precisely, and it's in between the lines of what has been presented so far, is building the digital ecosystem from the end user upwards. If there are positive value, the value proposition is positive for the end user, so in the case of agricultural value chains, we are looking at the farmers, and they accept digital payments, then they will the chain would follow, as we have seen on the off-taker side, on the coffee company side. There are very good reasons to move to digital. it is also in what we have noted with Jagalani Coffee Limited, but as well as with within other value chains, is the fact that the off-taker, the company, is not willing to push. Even there is a benefit in terms of cost, they are not willing to push down the chain something that is not accepted. And the reason being that in the case of Jagalani, there is a lot of work that goes into building the relationship with the traders and the farmers and making sure they get quality produce. So they rightfully are not willing to jeopardize that relationship. So on the other hand, what we understood is that as long as, for instance, in the case of Jagalani, the traders accept this form of payment, then they are all for it. Now, looking at the traders, the same happens. They will not risk having their farmers going to another trader who is actually paying in cash, and the farmer in that case wants cash. So they are willing, they see value in it, they are willing to push, but as long as their farmers accept it. So in the end, and this is true in the agri-value chains, but it is true throughout the ecosystem, if the end user, if there is customer demand that is created, so from the end user upwards, then the adoption is likely to follow through.
So thank you very much, Cyprian. We're just 10 minutes away from the top of the hour, and I want to thank you all that you've continue to stay on through the presentation. So we are now going to wrap up by highlighting some of the key takeaways from this work, but also want to thank you for the questions. We received so many questions, which is also a demonstration of interest in this piece of work. Just shortly, we are going to get to respond to them. So after it's all said and done, what really do the results teach us? I think what we see is that for digital payments to work, we have got to take an ecosystems approach, not just focusing inside the value chain. For example, making sure that the value proposition for the farmer, for the trader, or for the agribusiness exporter works for them. We have got to look inside the value chain, but also outside the value chain, people that play within the ecosystem, people like institutions like schools, clinics, hospitals, agri-input sellers, and stuff like that. Because ultimately, when the farmers are paid money into their mobile money account, they have got to use it to do transactions. And normally the thing that we see them do is that they're going to pay school fees for their child. They're going to go and buy inputs to prepare for the next season. They're going to pay for hospital bills. So if those institutions don't accept mobile money, then it actually creates a disincentive for farmers to accept mobile money as well, because then they have no ways of how to use it. So the approach that we've taken here in Uganda broadly is ensuring that there's a stronger value proposition for the actors within the value chain, but also going beyond the value chain and trying to create traction for other actors and making sure that their value proposition is also strong, and then the ecosystem is properly developed to allow people to accept, but also use mobile money. As you've seen in the presentation also, we see that cash out fees are prohibitive, and they are one of the key drivers that actually make mobile money more expensive than cash, because when farmers are paid into their mobile money account, then they have got to go and cash it out at a fee. So, and smallholder farmers from the CGAP research last year also indicates that farmers are very sensitive about price. So with cash out fees being prohibitive, then you have scenarios where you see that mobile money is actually much more expensive than cash. But this also borders around the use cases. If people receive money into their mobile money account and they have multiple options to use it within the digital ecosystem, then you kind of limit the cash out as it were. So we see that the moment the cash out fees remain, always cash will be always cheaper than mobile money. But we also see an opportunity for DFS providers, because this was the hallmark of doing this whole exercise. How do we drive MNOs into taking opportunity that exist within the rural communities, especially within the agricultural space. And what we see, as you saw in Cyprian's presentation, that the biggest amount of transactions happen within the first 3 bands. If I could just take you back slightly to one of the earlier presentations. Yeah, there you go. So you can see that the first 3 bands, that's where the biggest chunk of the transactions actually happen. So what we see with this whole analysis is that if MNOs are able to reduce cash out fees within those 3 bands, or even make them 0, then you have more people within the rural communities that do smaller transactions starting to accept, but also regularly using mobile money. And we see that this creates a lot of opportunity because the current MNO business models are focused on slightly larger transactions. So the smaller ones, because of the fees, again, you have not so many people doing smaller transactions using mobile money. So we see an opportunity in lowering fees with the MNOs that then allows them to bring in as many people as possible. And in the end, they can actually make money out of this. So if we take an ecosystems approach, making sure that the value proposition makes sense for everyone, if the mobile network operators are able to reduce the fees, cash out fees as it were, then we are able to see that the ecosystem is able to develop, and the value proposition for mobile money then starts to make sense for everyone. So these are just a few of the highlights that we see from this analysis. We've documented this also in a couple of blogs that are available that you can also read further. We also have the value proposition mapping templates. These are the Excel models that you saw my colleagues present earlier. These are available. If you're interested, please feel free to send me an email and we should be able to share those. We've also developed a YouTube video tutorial. As you've seen, exercise is quite complex. We've done this specifically in the value chain, but we think that some of you might be interested in taking this piece of work and trying it in other value chains. Of course, you'll get, across the different value chains, you can be able to apply the models. So we've created a how to develop your own model video that you can watch free on YouTube, together with the Excel models that I can send you on request. Then you can already start to see how to build these models. We're also going to be publishing another write-up that details the process, but also some of the key learnings that came out of this work. So these resources are available, and more that will come to continue to provide additional details and insights about this work. So I want to thank you so much for joining us this afternoon in Kampala. For more information, of course, feel free to visit the CGAP website, the UNCDF and PHB website. A lot of information is also available there. So we are going to move now in the question and answer session, and we've done a summary of these questions. So we'll try as much as possible to use the time remaining to respond to them. So the first question that we're going to tackle comes from Chris, asking, were all participants completely new to mobile money? Had any of them been exposed to UNCDF, MM4P awareness campaigns for digital financial literacy? It would be interesting to compare against baselines among different cohorts who had undergone learning to see advantages, stock incentives of interacting with the broader DFS ecosystem. Great question, Chris, and Bram will tackle that.
Yes, thank you, Chris, for that question. In this case, as I explained earlier during the start of this webinar, we are operating in multiple value chains. In this case, for coffee, we haven't done like a real baseline study, but a lot of the farmers have been in touch with, we call them booster teams. These are teams from the mobile network operator or from a third-party vendor that provide support in the field when it comes to sales of phones and SIM cards, as well as the training on the use of mobile phones and activation and usage of mobile money. Now, maybe interesting to mention is that, again, together with CGAP, we also work together in value chain of seed oil, and there is actually, this is exactly the topic that we are addressing, and we're definitely going to keep you informed on that post.
Thank you, Bram. Our next question comes from Charlotte, and you're asking, does the value proposition change if mobile money fees are reduced down to the level seen with M-Pesa in Kenya? And Cyprian will tackle that question.
Thank you very much for the question. Indeed, that is a part of the business case that we have been working on. It is indeed a very good start, for sure. Then in that particular case, it's also a matter of customer experience along pricing. And then we are also looking at who would be initiating the transaction, so on and so forth. But indeed, I think, let's say, the findings of this exercise are going perfectly into that direction.
Thank you, Cyprian. Gerard asks, my experience is that the cost of DFS will go down significantly if mobile money is an ecosystem. And you actually say that where you have even the street vendor selling fruits and streets is comfortable with receiving mobile money. And your question is, what have you done to ensure that in the farming areas there's enough network coverage, and what have you done to grow the mobile money ecosystem? Great question. Paul. Obra?
Yeah, let me take that one. Again, this is comes back to the experience that we have in this particular value chain. When we started a couple of years ago, on the let's say the slopes of Mount Elgin, where the project area is, there was not even network coverage. So we supported MTN actually by providing a guarantee to set up a tower, and that started. They were quite reluctant initially because they thought that this would not be a good business case. But actually, we by providing that guarantee, we managed to get them to put up a mobile base station, and eventually that has led to a fixed base station because they actually the tower broke even within their normal period of time, which is typically 6 months. Now, the other elements of the ecosystem in terms of building the agent network and ensuring that there is liquidity in the agent network, these are interventions that we have applied there as well. Initially with the MNO, but we decided to partner with a third-party organization that is, let's say, more agile and more nimble, that could handle more and is more flexible in the response to our needs, and that definitely has improved the, let's say, network coverage as well as the liquidity in the area.
Thank you, Bram. I also want to remind you that this webinar is recorded, so the recording together with the PowerPoint presentation will be shared using the emails you registered attending. So you will be able to get this. I've seen a couple of questions asking that. But I want to go to the next question from Joel. Great question. How do you remunerate the distribution network, POS, without cash out fees? As P2P and deposits already being free of charge for customers. So what you're basically asking that how do you remunerate agents when your cash out fees are free? Cyprian.
Thank you. This is a core question actually within this context. It is definitely the picture we are used to and we are looking at has a very an expensive distribution network altogether as of now. So of course that is a very important cost and is going to be more and more so as long as the logic goes from cash into digital and back to cash. So I think throughout what Paul was presenting also as findings and as analysis of what we collected as information is that there is need for a shift in that particular space. Now, of course, the transactions have to happen, and more transactions are captured, then that could create additional revenue streams for the service providers. And you know, one of the main ones that we can think of is related to, for instance, being able to use that data and to add and to provide advanced financial services through the channel.
Thank you very much, Cyprian. Anne asks, does competition at the DFS service provider have an impact? Bra.
Yes, I dare say we have some good experience with working with both mobile network operators across the various value chains. And when we started this project, we started with one mobile network operator. That was MTN, but we decided to expand our partnerships and include other mobile network operators. And we've seen that the responsiveness from the mobile network operators have increased significantly once you bring them in together. And it's really, I would say it's almost pitching them against each other, and that definitely increases the responsiveness across all works that we do. Although there is still a lot of room for improvement, because most of both Airtel as well as MTN, they have been working in rural areas, but they're more used to working in urban and semi-urban or peri-urban areas.
Thank you, Bram. Joel asks a very valid question. How do you integrate agricultural cooperatives in the process of digitizing payments? Do they have suitable materials in remote areas to make bulk payments, e.g. internet or computers? Paul.
Thank you, Nathan. Yeah, Joel, that's a very fundamental question, obviously. In this case, we're not working with a cooperative. We're working with Chagalani Coffee, which is a larger coffee company, but they do have 6 washing stations, and they're paying their farmers from those washing stations directly. And of course, like Bram was talking about earlier, network access was a pretty fundamental problem at the beginning of the project, which has been solved now. But the mode of payment was also a problem that had to be addressed. For example, the project started out with bulk payments, where a lot of people were being paid at the same time, and that kind of led to delays. And this is something that we also discovered during our qualitative interviews with the farmers. And so UNCDF chose to move to a different system where they focused instead on paying much smaller batches of people to be able to pay people a lot faster, so people wouldn't have to wait. Then in terms of access to computers and internet for cooperatives, I've also done some work in the dairy, on dairy here in Uganda with UNCDF as well, and that's focused on working with cooperatives. It varies, would be the short answer. I mean, some of these cooperatives, depending on their size, do have computers, and some new options are coming out and are already out there for making bulk payments directly through phones, and at least if you have a smartphone, that can be enough for bulk payments. And then when it comes to internet access, it is very widespread in Uganda. There are a few areas where there's absolutely no internet access.
Thank you very much, Paul. The next question comes from my brother Gerard from Zimbabwe. Are there any transaction limits on mobile money accounts, like transactional limits as well as monthly limits? If they are, what is their impact on agricultural payments? And Bram will take that.
Thanks for the question. It's a very interesting one, given the let's say the different dynamics in the various value chains. In this case, where the bigger off-taker or the agro processing company Chagalani pays to smallholder farmers directly, the transaction limits and the wallet limits do have little impact. However, the moment you start including the traders and the middlemen that deal in larger volumes, then it definitely is a challenge to overcome. To that extent, we are working with both MNOs to let's say seek workarounds for that. But it's a very valid question and a challenge that we in the different value chains, not only in coffee, but that we're working on to overcome.
Thank you, Bram. Chris, you ask whether digital payments can increase credit limits for those involved. Cyprian will take that.
Thank you. Thank you for this question. I think on that particular slide that was mentioned there, we are looking more from the off-taker, from the company's perspective, rather than the end user's perspective. I think this point is very important indeed as part of the value proposition for the end user. Part of it being the fact that they could eventually access more bigger loans, let's say, by the fact that they are actually receiving payments digitally. Nevertheless, I would say that in that particular sense, it goes back to indeed organizing the data that is available for that credit scoring. So in this sense, for instance, the companies here and the cooperatives or the agri-companies are actually they are quite close to their farmers and their traders. So indeed, going into the digital space would also help inform better, more adapted and fine-tuned, let's say, credit scoring algorithms, and could actually then give room for, let's say, specialized loans for instance, agri inputs, or what could also be done is produce warehousing and being able to get a loan against that.
Thank you, Cyprian. The next question comes from Emilio. Do you see digital payments leading to the offer of other types of DFS that could raise the value proposition? Great question, Emilio. Bram will take that.
Yes, I think it touches the heart of why UNCDF is working in agricultural value chains and trying to digitize the payments, because we see digital payments as the rails on which we can build other digital financial services. So digitizing payments it's only the start, and more we see other types of financial services riding off those services, such as Mocash is a good example, but also Pego solar solutions, such as the one from Phoenix, as well as Mkopa in Uganda.
Yeah, thank you, Bram. The next question comes from Jeremiah. So many questions in one. When you calculate the cost of DFS cash out, do you assume 100% cash out in one transaction? If so, one, is this possible, particularly for larger agricultural transactions, given transactional limits and agent float availability? And two, how beneficial is this, given that we are interested in DFS as a means to promote financial inclusion? Have you run the cost of DFS figures with multiple cash out payments, particularly for larger agricultural sales? Cyprian will take that.
Thank you. Yes, indeed. So the way we have modeled this and the way we have asked the participants about it is we have asked them for their, let's say, the value of their coffee sales and then how many transactions they're doing. So as Paul was presenting, this is mapped throughout the year, so on a month-to-month basis. Of course, the coffee season, the transactions, let's say, related to coffee sales are pretty much focused in specific months in the high season. So it is that average value that is considered basically in the model. And indeed, 100% of that cash out value, that transaction value is considered into the cash out. this for the farmers, let's say, or at a smallholder farmers level, this doesn't pose a problem against the limits that are on the mobile money wallets. However, as we were saying earlier as well, the trader who is in between, in some cases, transacts a lot, and then they have big transactions going on. So indeed, in the particular case of coffee, there are efforts done together with the service providers to accommodate and to put in place wallets that can accommodate those that level of transactions. Indeed, for the last part of your question, I would say that here the idea is to look at the customer behavior also. The fact that up to now they were receiving cash, and as they were getting that cash, they were planning for it. They were using it to buy this and that, and then getting home with some and storing it. Now, what we have seen already, and the feedback that we're having from customers as of now, at least, and because the use cases are so limited on the payment side, is that they are replicating the same. Well, they are actually rushing to the agent, and it's a matter of who gets first. So they get liquidity out of the people that are paid just to get that cash, and now do the usual thing that they're used to as before. So indeed, I think this goes back to the question of, and you know, the point that is made by taking into account the cash out fee, is the fact that as long as there isn't enough usage, there aren't enough use cases for the digital value to be used straight from there, people are actually going to rush to get the cash.
Thank you, Cyprian. And our final question comes from my sister Grace Akinyi from Tanzania. It's a bit a lengthy one, but we'll try to read it. Pricing is indeed a barrier to mobile money services. It looks like the banks and the MNOs are on a different page when it comes to financial inclusion. For instance, in Tanzania, the MNO has introduced a B2C charge, whereby on top of all the other MM charges, if a customer decides to maintain a bank account, then they will be charged for the transactions from the bank account to the wallet, and again charged at the point of withdrawal. Savings mobilization for banks is getting a hit from this, as transactions to the bank account then start to reduce. Are the MNOs the only stakeholders that want to promote financial inclusion? Or is this a war of who owns the customers and to whom should the customers be loyal, you ask? What is your take in this development in regard to financial inclusion and teaching people how to save? Great question, Grace, and Bram will take that.
I think this is a very valid point, specific, and it really touches on partnerships between various players in the financial inclusion space, and obviously the MNOs play a critical role in terms of like going that last mile and ensuring that there is a solid distribution channel. However, most of them are not able to offer more sophisticated financial services unless they start partnering with say microfinance institutions or with banks. And we foresee that whilst these payment rails are being laid, that other partners are joining, and we definitely see an interest in Uganda to go into more remote locations by the mobile network operators as well as the banks and these partnerships. I think it's early stage. We have some examples here and there, like CBA with MTN on Mocash is a good example. But if you look at some of the other markets, Kenya is a good example of that. We foresee that will happen more and more. But yeah, it's not going at the speed with which we as development partners would like to see.
Thank you very much, Bram. And with that, we'll wrap up our webinar this afternoon. And I want to thank you all for joining, those who have managed to stay on. We had over 130 participants joining us, which is really great. So from CGAP, UNCDF, and PHB Development, I say thank you and have a good week. Kwaheri.